Good afternoon, good evening, good morning. Whenever you're listening to this, if you're listening to it live, fire away with your questions. Today, I'm going to talk about, first and foremost, where rates are headed and what we're watching for. We're not that far away, as you're listening to this live, from January's inflation reading, which comes out Tuesday at 8:30 a.m. Eastern, 5:30 a.m. for us on the West Coast. I read a little bit about the small changes they're making to how they're interpreting that inflation data. One of them being like it's going to be a weighted 1 year versus a weighted 2 year. Shouldn't really have a huge effect, so I wouldn't worry about it too much, but know that whatever this inflation reading is for tomorrow and the digestion of it from the Fed and how they react to it is going to have an impact on mortgage interest rates. If we come in and inflation is way lower than expected, it's going to have a positive impact on mortgage interest rates. If it comes in worse, it could really open up the floodgates for continuing worsening of mortgage rates. If you've been following mortgage rates, you'll know that over the last week or so, it hasn't been the best run for mortgage rates. Just finally went as a national average. We ticked below 6%. That was on the 3rd. Was that? No. Wednesday the 1st or Thursday the 2nd. Right after that last Fed meeting, we had a couple of the worst days I've seen in a long time where we ticked up from 5.99 to 6.45 on an average, all in the matter of a couple of days. It's since ticked up even higher. And, if you wonder where these numbers are coming from, Mortgage News Daily has an average that's reliable enough from a nationwide perspective to just use. 2/13/23, their daily survey says 6.54%. So inflation comes in lower than expected. Things are looking great. The Fed, gets vocal about, okay, now our target Fed funds rate can be this number or that number. And it's lower than what people are expecting right now. Good, positive. In fact, mortgage rates will trend lower. If that inflation number comes higher and they say, you know what, we thought that getting the Fed funds rate up to about 5% was going to do it, but based on this continuing, even the newest talk track is some of the deflation that we're seeing. They're saying, I swear to you, this is not a joke. They're saying some of the deflation might be transitory. That's a funny word that anybody who's been following this stuff will get a great kick out of the Fed using the term transitory. But, if they feel like some of the deflationary stuff that we've seen is transitory and they've got to kick the Fed funds rate 5.25, 5.5, that's going to have a negative impact on interest rates where I wouldn't be surprised if you get 3 or 4 days of worsenings and you start to see this national average be something near 7%. I hate to say that. Knock on wood, we get some good inflation reports. But that's the most important thing to track and follow this week. Tomorrow, we're going to have a good idea of where rates are trending. For anybody who's a fellow mortgage originator, who I talk to a lot of you guys, most of us are locking loans and continue to lock loans in a volatile market. It's really, really, a big gamble to not lock. And I think that there is a little bit of upside that can happen with a good inflation report, but not enough to where you're going to risk somebody getting 1/4 or 3/8 higher interest rates if they don't lock on something that's closing in the next, call it 30 to 45 days. A lot of us have got bit doing that. So Ryan Lundquist, good to see you, brother. Appreciate you being here. For anybody who follows Sacramento Appraisal blog and Ryan Lundquist, me and him are going to be live here on March 6th, talking about the market as a whole, mortgage applications, real estate sales, real estate inventory, Ryan Lundquist on SacramentoAppraisalblog.com has just really good stats and follows the market really close, has some good insight there. So as far as what I'm seeing with mortgage applications, Ryan, I'm still seeing quite an uptick. The problem with it is I literally just was reading the market monitor from Black Knight. And it's funny because if you look at this and you look at lock volume, which is even farther along the track indicator of home sales and mortgage closings, because it's like first an application, then they get pre-approved, then they actually lock in a rate because they're in contract. It's almost like the pendings of real estate sales is lock volume for mortgages, because the pending, then it goes to sold, locked, then it goes to closed on the loan side. All these numbers have ridiculous month over month changes, plus 17% in New York, Dallas, Fort Worth, plus 40%, Washington, DC, plus 32%, Phoenix, plus 35%. The problem is month over month from December to January, December is traditionally super slow, right? And so I don't put a ton of weight into that, but like personally, me and my team, we looked at something like, what was the number? 43 applications and pre-approved 28 people in the last 10 calendar days. Mortgage applications are up. Contacts to our team to just chat and have conversations are up. It's hard to tell how much of it is seasonal. Those second 2 weeks of January, I think it was a combination of not just seasonal, but also rates trending down below 6%. So it was a little bit of tailwind from two areas. Tailwind from seasonality and it not being December anymore. We're into January. People are back on the hunt for housing, but also tailwinds from 5.99 looked a lot better than 7 and 6.5. So mortgage applications are up. What I wouldn't be surprised to see, Ryan, is that kind of not fall off, but slow down based on this recent uptick in rates. I'll say it here. I think a lot of people that follow this stuff closely would agree. This market is extra rate sensitive. Mortgage interest rates, and somebody said this really well, a comment on my channel, that that is a stronger lever than many other things, right? Is between 5 and 7%, depending on what band we're in for mortgage interest rates, it's going to have a big impact on demand. If we're 5 to 5.5%, that pushes demand, and demand's very strong. If we're 5.5 to 6.25, then we're somewhere in the middle. People, there's not a ton of demand, but there's also not none. 6.25 and higher, it really diminishes the amount of demand we have mortgage-wise, purchase applications. So we'll see, because if you follow that logic, then we've gone from the lower side of that band up into the lower side of that middle band all the way out to the last band, which is slow demand once we're up above 6.25, which it's also going to depend on price point and things like that. I had a group of real estate agents in my office earlier talking about the crazy that we've seen with a bunch of offers, escalations, multiple counters, things we haven't seen in a while at the lower price points. Stuff that I can almost guarantee you're not going to see at the $1.5 million range. But entry-level homes, sub $600,000, it's really, really competitive because there's not much inventory. Good evening from Lakeland, Florida. Thanks for joining, Kevin. Good to see you here, brother. Seems like sensitive is a good word to describe buyers. Yeah. Sensitive for good reason, right? Like buyers are sensitive about mortgage rates, conditions of homes, upgrades, location, and the price they're paying today. Yeah, they're paying a lot closer attention, as they should, but probably out of necessity. If you're getting a 2.875 and your mortgage payment is 2272 or it's 2314, you don't necessarily have to look at the fine print. Once you start getting into the higher interest rates and you're like, man, 3450 as a mortgage payment, that's up near my max comfortable limit. Buyers start paying attention to all the details. What's the exact interest rate? What's my exact payment? Is this the house that I'm going to say it's worthwhile to take on that debt at this rate, at this monthly payment? So you're 100% right, Ryan, that buyers are more sensitive in a lot of ways, and with good cause, with good reason. Warrior Ranch Northwest, do you believe assumable mortgages will become popular? This is something that I get so many questions about. And here's what I'll say about it. I've written $500 million in mortgage loans over the last half decade. A lot of loans. So I've talked to thousands of consumers. I've talked to unlimited numbers of real estate investors. The amount of assumable mortgages that actually get assumed is so minuscule that it's almost not worth spending time and energy chasing. Meaning that even though government loans are assumable, you can't assume conventional, which, oh, by the way, probably makes up 70% of the loans out there because everybody refinanced into conventional loans in 20 and 21. But let's say that it's the smaller cohort of government loans. If those are assumable, realize that it's got to be a perfect storm of you've got $288,000 in debt. I'm going to assume that. I've got the down payment to get from that number to what you're trying to sell it for. And then you've also got to have a seller that's willing to wait the 3 months that the average servicer is going to take for this whole assumption process to go through. More often than not, and it's like a 99.9994, it's just not an option. And so it doesn't get done. And that's why of every 1,000 homes sold, I would imagine that less than one gets a loan assumed. It's good in theory. In practice, doesn't really work. I think you meant to write why, Dusty. Why do you think tomorrow's inflation data will bring down rates? If the question is why, I don't necessarily think it's going to bring down rates unless it comes in and it's a lot lower than expected, and the Fed has really nothing to say after multiple inflation readings in lower than expected, showing the downward trend in inflation. They really can't spin a bunch of rate hikes when there would be proof and data showing that, like, listen, you've done so much that look at these past 4 months of inflation data. Inflation is coming down, because that's all they care about, is that inflation comes down while still maintaining jobs. Like that's their mandate. Stable job market, inflation down. And they've said it a ton of times. And so, in my opinion, another low inflation reading is just going to be like, all right, like it's on its way. You can take your foot off the gas. We can coast to the destination now. I was going to share this because I think it's interesting too. And honestly, I pulled it up and I didn't get a chance to read it. So I was like, well, we'll read it together. Let me know if you can read this, if it's clear on your side. This is that market monitor that I talked about from Black Knight. They do this every month. And so this is the January report that just came out, looking at like national rate lock metrics, market rate indices, a really interesting 30-year versus 10-year treasury spread. And we'll talk more about that because that's a really interesting topic. When you want to talk about the future of interest rates, the spread between the 30-year mortgage rate and the 10-year treasury, generally 1.8 to 2%. It's a lot higher. And I'll tell you why. And I'll tell you why that is a good thing. And maybe we'll skip ahead to that. Maybe I'll start there. Lock volume by loan purpose, mix of business by loan product, average credit scores, purchase refi pull through, and whatever the hell that says. Best efforts to mandatory spread. Let me skip to page 7 because I want to talk about that. Then we'll get back to this indice, which kind of, to my earlier point, paints this crazy picture that that there's a ton of lock volume going on, which there is, but it looks better than it really is because December was so slow. This should say January of 23, 30-year to the 10-year treasury spread. And, mortgage rates loosely tied to the 10-year treasury. If you look at this, where does this go back to? January of 22 to January 23. Up here is the 30-year fixed rate mortgage, which now hovers above 6%. This blue line right here is the 10-year treasury, and then that dark shadow is the spread. And so if the spread is historically, and this is, I'm talking before something that's not even on this chart, before this chart. Historically, I'm telling you, it's between 1.8 and 2%. So just these first 2 months of January and February right here, like that's what it usually is, 1.8 to 2%. Over the last 10 to 12 months, this spread has gone, no way, 4%? It peaked above 4%. Now it's at about 3.5%. We got a 10-year treasury. What was it today? 10-year treasury is 3.7. Average mortgage rates are 6.5. So what's that? 2.80, 2.8% spread. Here's what I'll say about this, and I won't be too long-winded about it. The more volatile mortgage rates are, the bigger the spread. I literally heard this straight from the belly of the beast from somebody who's working on this stuff day in and day out. It's a function of volatility. Right now, mortgage interest rates are very volatile, therefore bigger spread. Once there's less volatility in the market and things calm down, we'll get back to a more normalized spread. If you want the layman's terms for all that, once mortgage rates are more stable and there's less volatility, less Fed involvement in tinkering, if the 10-year treasury is at 3.7, you can expect mortgage rates to be at 5.7. If the 10-year treasury is at 3%, you can expect 30-year fixed rate mortgages to be at 5%. And so if you're rooting for 5% mortgages, you're rooting for stability in mortgages, less volatility, the 10-year treasury down to 3%, and then you've got a 5-year, 30-year fixed. If that's going to happen by June of 2023 is yet to be told. It's not looking good for us that are on that train. But 'tis what it is. All right, let's look at the lock volume here, which is up substantially. Look at that. Whoops. What'd I click? Oh, I just clicked on the sheet. Up 17, up 41, up 32, up 35. Is that 51? Up 51 in Chicago. These are month over month changes, so I wouldn't put a ton of stock into that. Obviously, as you can imagine, 80 to 90% purchase. Not a lot of refinances going on, although I think in this report, it talked about a lot more refinance volume in January as rates came down. This is interesting to see, rate lock volume going up. But again, remember that it's month on month and it's comparing to a really slow month of December. So it's not, an indication that like the market has gone crazy. Average 30-year fixed across loan products. FHA, conforming. Yep. This is January, remember. So 6.16 sounds pretty good right now. You're going to have to pay for that here in mid-February. That's the spread one we talked about. Lock volume by loan purpose. That purple line is purchase. So as you can see, those of us like myself who are very purchase heavy, we're not talking people into a refinance that only makes sense in the scenarios where you've got investments or you've got good cause to refinance. Vast majority of business is purchase business. Cash out refinance makes up a little smidgen. Rate and term refinance, even smaller smidgen. Mix of business by loan product. What do we got? Conforming, which is conventional, right? About 60%. Look at that. Look at FHA up to 18.5% and VA to 12.4%. That is a good sign. Those two government loans, VA, you've got to qualify and you have to have earned that benefit. FHA, a first-time home buyer product that's really, forgiving for people that don't have perfect credit. It allows for lower down payments. These are the buyers that got shut out in 20 and 21. And so as the market softened, as it became, less competitive, these buyers had a chance. And it's really cool to see this uptick and these buyers getting a chance. 12-month delta, meaning how much does it change in the last 12 months? It's up 7% in FHA, up 4% in VA, down 5.5% on the conforming, on the conventional stuff. Cool. Average credit scores. This is, you guys want to hear my real feedback on this? Check this out. 20 and 21, great credit scores. And this is cash out refinance. And then it kind of fell off a cliff. I know enough people who will give me data about cash out refinance, and it will be broken down by lender. So if you wonder why the average credit score is so much lower for cash out refinance, my thought, and this is not a nice thing to say, there's some lenders that are predatory out there. I don't know if it's necessarily, okay, I won't name names, but a certain lender does far more cash out refinance for sub 700 credit score than anybody else. You can't tell me that that's not a company thing, a culture thing, a practices thing. They're not doing that by accident. You don't stumble into doing more of a certain loan type than anybody else by accident. So if you're getting calls and you've got a 690 credit score and they're telling you, listen, like, I know you've got a 3% and this new rate is a 7.75 because your credit's, not perfect, but you're going to pay off this debt. Don't fall into that, please. That's my only ask. That it just rubs me the wrong way. And I have the same conversation every couple of weeks with a data analyst that I talk to that tells me lender specific who's doing this stuff. Not cool. Not cool. All right, enough on that. Average credit scores. When you're getting a conventional loan, that average credit score is up near 750. Interesting thing when it comes to credit scores and just credit availability. I saw something recently and it said that sub-crash credit availability was like 900. Higher the number, the easier it is to get a loan. So as some people know, 03, 04, 05, stated income, stated assets. If you could sign, you were in, right? 100% loan to value, even higher in some cases. That's 900. And then pre-pandemic, we had about 200 as the number. So a lot harder to get a loan than it was then. The recent number is like 112 or 119. So it's even harder than it was in 19. And in 2019, it was exponentially harder than it was when it was super easy. So, it's not credit standards and credit availability is more stringent than really it's been in decades. They're not just giving out loans to just anybody. And as you can see, mid 750 score, even on the VA stuff, that average credit score is, 705, 710. That's probably a 705, right? And then FHA, their average score is about a 660. In FHA, you can go down to 580 and put 3.5% down. You can go down to 500 if you want to put 10% down, but still the average score is a lot higher because underwriting guidelines and getting loans, it's more stringent than it's been in the past.
I'm not sure I understand.
I'm not talking to you. Watch. Purchase pull-through, refinance pull-through. This is the number of locks that became funded loans. Like I talked about earlier, when you're in the real estate game, you've got pending sales and then they turn into sales. In the mortgage game, you've got locks where you submit a loan and you lock it. That turns into a closed loan. This is the pull-through. Dang, this pull-through rate is low. Purchase pull-through, refinance pull-through. This is nasty. So 70%. So 30% of loans that get locked don't close. This could be a number of things. This could be locking with multiple lenders. Not a common practice, but I'm sure it happens. This could be locking with a lender, then flipping and going to another lender. Again, don't recommend it, but it probably happens. There's people backing out. Yeah, so lock a loan, get an inspection report back. No thanks. Don't like that house. Backing out. But yeah, it still surprised me that it's that high, 30%. Then we've got the refinance pull through, 50%. So half of the refinance locks, I don't know the lenders that are putting together these packages, locking the loans, and then just abandoning ship. But my guess is that they're just kind of willy-nilly locking them, perhaps. Woo! Look at that 12-month delta. That's down 25% because it's down to 47. And then down almost 10% on purchase. Purchase usually 80% pull through, and it's down to 70. Wow. Interesting times. You lock it. The client doesn't like the house. The client doesn't like the mortgage payment. The client doesn't like something. Jumps on purchase. On refinance, the appraisal doesn't come in. The numbers don't align with what the client thought they were going to get. They back out. That's interesting stuff. Very interesting. Oh, this is margin spread stuff that really nitty gritty, boring mortgage stuff. You guys don't want to hear about that. Fire away with any questions you have. I'm planning out the next few months. Like I talked about, we got Ryan Lundquist, Sacramento Appraisal blog. We're going to be on March 6th. I think the week before that, I'm going to have my friends at My Credit Guy on talking about that, because I think what we might come into pretty soon, I'm already seeing it, is people that enter into my world. We review things. They've got some credit work they want to do. They've got more savings they want to do. They're just not ready. In the meantime, put a little focus on your credit. Have your credit go from 640 to 720. When you're ready to buy, a lot more options available, a lot better terms available. Credit is an important piece, and I want people to get that. So I'm going to have my friends at My Credit Guy join me for a collab on that. Anything else you guys want to see, let me know. I'm going to get to some of these questions, but fire away questions. I'll be on here for another 10 minutes, and I love the back and forth and the questions, whether it's mortgage related, real estate related, my thoughts on why the Eagles didn't win the Super Bowl, whatever you want to hear, I'm happy to help. What's your opinion on Taylor Morrison as a builder and as an in-house lender? Most all these builders have their own in-house lender. I'm not going to speak specifically on builders. Taylor Morrison does a fair amount in the Sacramento region. So I guess I haven't really dug in and investigated them. I haven't heard a lot of bad stuff. So that's probably a good sign for them. So yeah. But as far as like the lending piece of it, in-house lender, 71, it's between 71 and 73% of people who buy a new build use an outside lender. They go somewhere like greatmortgagebroker.com. They fill out the form, they connect with my team. If that in-house lender is offering you $5,000 of incentive, but we're $7,500 better, don't even bother doing the math. I can do it for you. You're net $2,500 better off using an outside lender. That's why 71% of people end up using an outside lender, because it's going to be better. So with that being said, I would just say if you've got questions on the lending piece of it, get a quote from their in-house lender that generally make you do it anyway, and then just compare it with an outside mortgage broker you like and trust. I'd recommend going to greatmortgagebroker.com, but that's me. How do you beat out cash offers? This is a good question, Colin. And this is going to be highly dependent on the seller, on the area, on the price point. I had a buyer recently put together what was like a perfect offer, and the agent did everything they're supposed to do. They talked to the list side agent. What does the seller want? What does the seller need? What's the price that is likely going to get accepted? How do I write it as far as how long of contingencies, everything. And then when the agent sent the offer over, this offer, this much seller credit, this close of escrow time frame, this for all the other contingency periods, The response from the list side was like, thank you so much for the conversation. Thank you for sending over an offer exactly like we talked about. And then they get beat out by a cash offer. And I'll tell you why from a real life scenario. They got beat out in that scenario because that home had fallen out twice, where a buyer with financing came in and backed out. I don't know the reasons for the last two backouts, whether it was something to do with the loan, condition of the home, or just the buyer's, sentiment. But for that specific seller, the idea of a cash offer where it would close quick and they'd be done with this chapter, like get this house sold, trumped everything else. So in those cases, you might not have a shot. But most sellers, I would imagine right now, are going to look at all the options presented and pick the one that nets them the most money. 550, 3.5% down FHA. 535, 10% down conventional. 490, cash offer, close in 10 days. In that scenario, I think most sellers are going to say, I want 550. If they can have their agent talk to the buy side, and I say, listen, it's an FHA buyer, but they're strong. I've got a full file. We verified everything from their employment to their assets. We've ran the desktop, approval. We can close it in 21 days. Give them some assurance. It's going to net them the most. They're rolling with us, right? They're not going to take 490 cash. They probably wouldn't even take 520 cash if it's going to net them 30,000 less than if we close in 21 days with an FHA loan. So in order to beat cash offers, you probably have to be higher than them. That kind of goes without saying, because if somebody has the option of financing where something could go wrong, no matter how good the lender and the buyer are, and a cash close that might happen in 10 days or 12 days and more likely to get to the finish line. I think that's really all you can do. But having a good agent who knows how to structure offer, who knows how to talk to the list side, a good lender who's able to communicate to the list side how strong you are as a buyer and give them some assurance that you'll get to the finish line. That's what sellers want, is assurance. Cash offers them that. That's why they like cash. But right behind that is a pre-approved buyer with a lender that they've talked to, that they've verified with, that they trust, that has a good reputation, saying, yeah, I'm going to get to the finish line. Yeah, we can close it in 18 days. And then all of a sudden that assurance meter isn't like cash offer here, loan down here. It's like cash offer, yeah, loan here. We've talked to this person. And then maybe there's some, out of the area online lender that I don't know, that one may or may not close. That's the best I got. What are some trends you are seeing with appraisal waivers? I mean, truth be told, we're not seeing as many of them. And maybe that's a function of this chart we just looked at, where there's more and more FHA, VA. The stuff that's getting into contract right now isn't 25, 30, 40% down conventional. The stuff where we saw appraisal waivers. That's somebody calling on appraisal waivers. But yeah, not seeing a ton of them, to be completely honest. Okay. Beck Ka, I got quoted 7.5 on a conventional loan in Tennessee. Some stuff going to Tennessee. My boy Connor yet? Connor could get you dialed in Tennessee. $200K purchase price. I'm guessing you're putting 25% down. If you're worried about rate, you should be, because 25% on investment property is going to look a lot better than 20%. I can tell you that every day, including Sundays. But if you've got good credit and you're putting 25% down on a 200 purchase, let me take a little, because you're only telling us part of the puzzle, right? 7.5% on a conventional loan. You got to see how much that 7.5% cost. If you got 7.5% with 2 points, might not be so good. If you got it with no points at all, might be a good looking deal. But Yeah, my guy Connor. Go to greatmortgagebroker.com, or you know what, Beck? I was pricing it for you here in the background. You should be able to. Oh, looky there. Yeah, you should be able to get yourself. Ooh, looking good. You should be able to get yourself in the sixes with a couple points. And on a 150 grand loan, a couple points is 3 dimes. Or, in the mid sevens for less than a point. Do this. Oh, 2 points on 7.5? Oh, we better. We're a point or less. For those same 2 points, we can get you to 6.9. So you got to call us for sure. For sure. My guy Connor. Do this. Go just shoot an email, team@mtmg.com. I'm buying something in Tennessee. Connect me with Connor. And I'll connect you with my boy Connor Wilson. No problem. Connor will lace you up. I promise. All right. That's a done deal, Beck. We're in business now. You're going to get yourself a good-looking loan. Good thing you talk to a great mortgage broker. Okay. Allah Abdu Khalil. Thanks for joining. Appreciate you. I'm doing reference. I received email approved with conditions. We sent the documents to the bank this morning. This afternoon, someone called me for close tomorrow at his office. I'm not sure what the question is here. You're wondering, what you should do there? I need more info. You're welcome. We'll look for that email at team@mtmg. Connor will take care of you. Rambler, coming off forbearance, take the 40 years or the deferral. This is this is taking me back to 2021, right? Where a lot of people were in forbearance. They're coming out. I was talking to a lot of people just trying to, even though it's not my department, right? I originate loans only. I don't deal with modifications or coming out of forbearance, but it interests me and I like helping people. There were some good options for people to go into a 40-year term where it really fit within their budgets. And what I would say, Rambler, for you is you want to look at your options and find out which one works for you. Because it's hard to say, do I take a deferral or do I take, a 40-year? By deferral, my guess is that they're saying, leave your loan alone, continue to pay your monthly payment, and we've got, $17,000 or $22,000 or $28,000 that will defer to the back. If you refinance, you'll pay it off. If you sell your home or pay off your home, you'll pay us that off, but don't worry about that for now. That'll just be like a deferred balance. Or you owe $288 plus the $27,000 in deferred payments. Let's put it all together. Let's get you a brand new loan at 300 and whatever those numbers combined is, right? 316. And I don't remember the first two numbers I said, so don't hold me to the math because I just guessed 316 over a 40-year term. And so, have them present you your options. If it's hard to tell which option suits you best and which would be the best for you, send it to team@mtmg.com. And I'd be happy to, because I like knowing what's going on with that type of stuff. And so, that's your payment to me, is I get a little bit of insight into what mortgage companies are offering in return to you. I'll talk you through it, and see if I can offer some insight or so. Do 40-year loans have bigger loan balloon payment overall? I don't think. I think if they do a 40-year, they're going to have you pay it all off, and there wouldn't be any balloon. The balloons come from the deferral of what you missed during that forbearance period, and there shouldn't be any interest added. It should just be like, there's a $28,000 in missed payments that's back here. It's not accruing and growing, and then the balloon is one number on a 30-year loan and a bigger number on a 40-year. It shouldn't be like that. At least I haven't seen that. So press the servicer to give you the options, and they'll always give it to you in writing. All right, back. I'm refinancing my home. Friday, underwriting approval. What condition? This morning, we sent the documents. Afternoon, someone called and said, let's close it up today. Is that good or bad? Well, that's good. That means all the conditions are cleared, and they've been able to generate docs and have you sign docs, and you're good to go. So I think that's a good thing. Just review the closing disclosure, review those docs, make sure that everything that you set out to do with this refinance kind of matches with where you started. And it sounds like you're good to go. Sounds like you're working with a fast moving broker who probably submitted for the clear to close bright and early, got it cleared and got docs generated. Now you're on your way to closing. So sounds like a good thing from my perspective. All right, I got to roll. I got work to do. We got a busy time in real estate right now. People are out there submitting offers. Stuff is happening. Some of the people that are bearish on real estate are scratching their heads, because this crash that they're dreaming of in their head hasn't happened. And then you've got some people saying that we passed the bottom. So peak to trough, Sacramento median might be down 15%. And it might be all uphill from here. Time will tell. Thanks for watching, folks. If you've got any questions for me and my team looking to get pre-approved, the best place to go is greatmortgagebroker.com. That will ensure you're connected with the right person on the team from the area you're in who can best serve you. Questions, comments, concerns, if you're watching this on replay, leave it down below in the comments section. As long as you're nice, you're not being mean to me, I will answer those. One last thing, I better put this in. Can I copy this somehow? Oh. This is the link to the Tony Robbins event I'm doing Wednesday, and everyone's invited. How do I? Anyway, I'll send stuff out. Follow me on all the socials to get the link to the Tony Robbins event. It's going to be a cool one. Peak Performance Workshop, Wednesday, February 15th, 10 a.m. Pacific Standard Time. I know that, and I'm going to be there. You should be there too. Thanks, guys. Talk to you soon. Bye-bye.